I want to bring in Gerard Cassidy right now. He's at RBC Capital Markets. He's on the Squawk Newsline, taking a look at this news just the way we are. Literally, this news is out 7 minutes ago. Gerard, your initial thoughts?
Our initial thoughts are quite favorable. What we've been saying for some time, and I've been sounding like a broken clock, that we expected these large, big regional bank mergers, and here we are. We have one which comes as no surprise that we're getting the big mergers. And I think you guys just mentioned, the technology spending is one of the reasons why I think you're going to see these mergers continue on a go-forward basis.
Okay, so let's sort of walk through the permutations, both first of this transaction itself and then sort of walk through maybe some of the other banks that you cover in terms of what may or may not happen to them next. In terms of this being a stock-for-stock merger of equals, there is no premium on either stock. Is that right in your mind?
Yes. I think one of the things we have seen recently in the last couple of years is transactions where there's been sizable premiums and meaningful dilution to tangible book value per share. The reaction from the markets has been quite negative. Last week, we saw a merger of equals of two banks, and there wasn't much dilution at all, and the stocks reacted favorably. So if you can create a combination of companies with minimal tangible book value dilution and earnings accretion, that's good for both sets of shareholders, and the market tends to react favorable to that.
What does a combined BB&T and Suntrust threaten at this point? And who might be next to buy?
Yeah, I don't know if it threatens anybody per se. It's going to make them, of course, more efficient and over the long run probably more profitable. But you have to ask yourself, if you're any bank with $100 billion in assets or more, should you start to consider something like this? This is certainly going to create the sixth largest bank in the United States, and I think that you should anticipate other large regional banks considering to do similar types of deals.
Gerard, to what extent is this a defensive move rather than an offensive move? When you see the size of investment, for example, in technology that the big guys are making, is this something that needed to be done to fight back to the big guys?
I think it certainly is part of the strategy. When you can combine two companies of this size, the cost savings will be meaningful. And the only way that you can create that value on cost savings is through a combination, obviously. So I think what we're seeing, and we saw this, remember, our banking system back in the 1980s had over 14,000 banks. Today it's 5,700. Who would have imagined in 1988, 89 that Chemical Bank, Manufacturers Hanover, Chase Manhattan, J.P. Morgan someday would become one bank, which is what it is today. So I think what you're going to find is other big regional banks need to do or consider these combinations as a way of increasing profitability.
That was sparked by national interstate banking legislation, though, Gerard. I mean, do we see that sort of push for the consolidation of the banks that remain today, or is this just going to be a story of finding new efficiencies in this kind of market?
I think it's finding those efficiencies, and there's no better way to do it than combining with a neighbor or a competitor, because you cannot achieve those efficiencies unless you combine the two of the banks together. So I would anticipate there'll be more of that.
Let's just talk a little bit about how you think this is going to be received in Washington among regulators, among those with pitchforks out, given the political climate and conversation that we seem to be having every day. Do you think that this is going to be looked upon fondly? I have to imagine there are going to be folks, especially on the left, who are going to come out against this almost immediately.
From a political standpoint, you're probably right. But remember, from a regulatory standpoint, last fall, the regulators came out with a new classification of a bank, which is a bank between the asset size of $250 and $700 billion. So that was the green light, in our opinion, from the regulatory side, which is the important part. And in our view, the regulators are very supportive of these types of deals since they've created this new category of bank, which will be treated as a larger regional bank rather than a global SIFI.
Gerard, we're looking at the release here, and it says Kelly King will become a chairman and chief executive officer of the new bank. Bill Rogers, of course, who is the Suntrust CEO, will become the COO. What do you make of that going forward, that setup?
That's clearly what you need to see is the different roles for each CEO. Clearly, there will be some active jockeying of positions of the different senior executives. But generally speaking, in these mergers of equals, you do see both CEOs take an active role, at least initially. You might recall when Bank One and J.P. Morgan Chase merged, Harrison was the initial CEO, and then Diamond took over after that. So I would expect over time, obviously, there will be retirements, but at least initially, both of them will be very active.
I should point out as well that Bill Rogers will become the CEO come September 2021 as well, moving forward. In terms of regional presence here, these guys are strong in the southeast, the mid-Atlantic areas. Who do you think is going to be feeling the heat most of all of this, whether it's the big banks that have a presence there or other rivals that are strong down in that region?
I would say it's probably the rivals in that region. Remember, obviously, lending and banking is a commodity business, and efficiencies of scale are critical. And so, to me, that's where you're going to see, the pressure on the other competitors is that if this bank can be more profitable because of the efficiencies that they will generate, then we would say it's more of a regional, issue rather than having the national banks that have presence there.
Right. Hey, Gerard, do you put buys now as a result on basically every public regional that's out there on the assumption that there's going to be a transaction? I'm just looking through the list right now. Also, we were talking about PNC earlier, for example. They do get they would start bumping up, or it makes it a little bit harder for them to bite off a big deal in terms of trying to capture that sweet spot before the regulators might look at this less fondly.
We have been very positive and bullish on the banks for quite some time. Obviously, it was a very painful year last year. And one of our premises why we were so positive was because we expected deals like this one to happen, and it's been taking longer than we thought. But now that this is here, and I would suspect that as others take a look at how these stocks react today, we don't know yet how they're going to react. But let's assume if it is positive, others will take a real hard look at possibly joining forces with a nearby competitor.
Where are we in the valuation of regionals? It's a group that's up 15% so far this year, as you mentioned. I mean, obviously, it's a group also that got clobbered in the December sell-off. Yeah. But are we at fair valuation? Do you think it fully reflects the possibility, the upside possibility of more consolidation?
I would say that the valuations as of yesterday, before this deal was announced, for the banks were still below their long-term averages. Mm-hmm. As you accurately pointed out, December was extremely difficult for the banks. They've recovered some of what they lost in December. However, they haven't fully recovered. So we still felt, and still do, on a fundamental basis, there's still upside for these banks. And certainly, if the stocks react favorably to this news today, there's even more upside because of expectations of further consolidation down the road.
What do you make, Gerard, of the fact that it has taken so long? When we started to see a slightly better regulatory environment for banks of this size and all the attractions that we've been discussing of a potential deal like this, why has it taken so long?
I would say that the primary reason it's taken so long is that first, obviously, you had the fallout from the crisis. We all know that. But then in the last 3-4 years, it's been record profitability for the industry. And so there was no real compelling reason to have to do something. But as the digitalization of banking has advanced, it's becoming more challenging to be able to achieve this record profitability on a go-forward basis. And so I was expecting that in 2020, that will be the challenging year for bank earnings. This year we'll still have a good year, but 2020 more challenging. So I think now CEOs are seeing that and saying, you know what, maybe now is the time to do a combination because of the challenges in the profitability from the core businesses that we're seeing today.